Our final topic for Chapter 6 is the election to adjust the basis of assets. And as I told you in the last video, this is tangentially related to liquidations, but it is now separate from liquidations. A corporation may elect to adjust the basis of property held by a subsidiary after the subsidiary was acquired by purchase. Frequently, this is referred to as a Section 338 election. It often results in a step up in the basis of the subsidiary's assets, and this may be the main reason to do the 338 election, is to increase the basis of the assets. Requirements are the purchasing corporation has acquired at least 80% of the stock of the subsidiary by value and by voting power within a 12-month period. The acquisition of the stock was a taxable transaction. So we'll see in Chapter 7, you can acquire a corporation in a non-taxable transaction, usually with an exchange of stock. But if you pay cash for that corporation you just acquired as a subsidiary, then it will be a taxable transaction. And you have to make the election. It's an election, so it's not automatic. You must make a timely election in order for this to kick in. The deadline for the election is the 15th day of the 9th month following the month in which the acquisition of 80% was achieved. The result of the election is what they call a quasi-liquidation. So we're going to kind of pretend to liquidate the subsidiary even if we don't actually liquidate it. We can actually liquidate it if we want, but we don't have to. So the subsidiary is going to sell all of its assets to a new corporation for the fair market value of those assets. That new corporation that it's selling to is itself. The new corporation, actually the same subsidiary, is purchasing the assets for their fair market value. So the subsidiary in its old existence goes out of existence, and a new corporation comes into existence, wiped clean of everything that it had before. Brand new corporation, even though it's actually the same legal entity that it was before. Subsidiary, as its old self, is going to recognize gain or loss on this pretend sale, and the basis of the assets held by the new subsidiary in its new identity is the fair market value of those assets. Subsidiary's earnings and profits is wiped out and starts over at zero. Possibly the elimination of earnings and profits is the reason to do this quasi-liquidation. If you have a chance and you can wipe out $3 million of E&P, that might be reason enough to do it, depending, of course, on what kind of gains you have to recognize in the process. Take a look at problem number 65. Before we get into the details of how to do things, this is fairly simple problem. On July 15th, 2023, Lilac Corporation purchased 25% of Coffee Corporation stock. Lilac Corporation purchased an additional 40% in coffee on March 24th, and it continues on. For purposes of the Section 338 election, what date does the qualified stock purchase occur? And what is the due date for making the 338 election? So we saw that July 15th, 2023 was the first purchase, and that's 25% of the total outstanding shares. So at this point, cumulatively, we have 25%. Then it went on. I stopped reading at this point, and they purchased an additional 40% on March 24th, 2024. So 40%, now we're up to cumulative 65%. Remember, we got to get to 80. On May 5th, 2024, we purchased an additional 20%. Now we're at 85. Now, before you say, okay, we're done, go back and look. When was the first purchase? It has to have been within the same year. Well, it was. We had until July 15th of 24 to get to 80 or above, and we made it. We got to 85 on May 5th. Had they not, Had they bought another 12%, so they would have been at 77, and then they didn't buy the rest until after July 15th, well, no, sorry, you can't do the 338 election. But they can. They've got their 85%. They also say that on September 24th, 2024, they bought the remaining 15%. Now they're at 100%. That doesn't matter. You can leave that last 15% and never purchase it, and you're still eligible to do the 338 election. So the question was, for purposes of the 338 election, on what date does a qualified stock purchase occur? May 5th. Cinco de Mayo. That's when you get to more than 80% purchased in a single 12-month period. Notice also, by the way, they could have held 10% of the shares since June of 1998, and they still would have been able to acquire. Now they'd have to get up to 90% within a one-year period, but you don't have to start at zero. This corporation did, but you don't absolutely have to. Anyway, our acquisition date is May 5th. Now we've got till the 15th day of the 9th month following the month of acquisition. So June, July, August, September, October, November, December, January, February. We've got until February 15th, 2025, which is Saturday, which is after I'm recording this. It might not be after you're looking at it, but February 15th, 2025 is the deadline. If you're looking at this on Monday, oh well, too late, can't make the election. Now, how are we going to do this election? What are the specific mechanics of the election? First, compute the fair market value of the subsidiary's equity. That's usually fairly easy. The shares acquired before the most recent 12 months. So I said, well, you bought 10% back in 1998. Those cannot be, of course, more than 20% of the total shares because you have to buy 80% or more within the 12-month period. Those value at whatever you paid for them when you bought them. Shares that you did acquire during the most recent 12 months, so that's at least 80% of the total, those value at cost. What did you just pay for them in this purchase that you made within the last 12 months, or these purchases you made within the last 12 months? And then what about shares that you never acquired? That was not the case with the problem we just looked at. They went and got 100%. But if you didn't get 100%, then what's the basis of those? Well, just compute that based on your recent costs. So if you had 10% that was prior to the acquisition, and then you bought another 80% during the last 12 months, well, now you've got 10% that you just never acquired. You've got 90%, and other folks out there have the other 10%. You don't go out and ask them, what'd you pay for your shares? Doesn't matter. Just look at what you paid for your shares, add that all up. That's your basis in those 80%. Well, 1/8 of that is 10%. So 1/8 of your cost will be the cost that you attribute to the shares that you never did acquire. So that is how you compute the fair market value of the subsidiary's equity. You've got most of those numbers, and for the ones you don't have, you can just use the costs that you paid to calculate the basis of those shares. Add the value of your liabilities, and now you've got the value of your total assets. So what we're going to do is now allocate that value to the assets. That's what we're trying to do, is figure out, well, okay, what's the value of all my assets? Allocate the value to your total asset. Cash and cash equivalents, you can't do anything other than face value for that stuff. A $10 bill is a $10 bill. You can't call it a $12 bill just because you have extra value to allocate. So that's going to go at face value. Securities, certificates of deposit, foreign currency, value that at fair market value. All other assets also value at fair market value. Now you're wondering, why did I have two categories? I'm doing the same thing for both. You'll see that in a second. Anything left over, the residual, goes to goodwill if it's positive. If you have extra money left over after you valued all the corporate stock, what you bought plus what you didn't buy, now allocate that positive residual to goodwill. And remember, when you're talking about goodwill for tax purposes, that is amortizable over a 15-year period. That is not the case with goodwill for financial accounting purposes. If that number is negative, here's why we had two categories valued at fair market value. If it's negative, prorate to the all other assets. Do not put any of that negative value in your certificates of deposit, securities, and foreign currency. Leave those alone for fair market value. But in terms of your equipment, your building, your land, and all the other stuff that's in the all other assets, then prorate your negative residual, if you have one, to those assets. So bring down the value of your land, your inventory, whatever else you have there, in proportion to the fair market values. Problem number 66. On April 23, 2024, AUK Corporation acquired 100% of the outstanding stock of Amazon Corporation. Really? Amazon? No, it's a different Amazon Corporation. I am not sure that you're allowed to call your corporation Amazon Corporation. Somebody's already got that name. Anyway, this is a little Amazon Corporation with earnings and profits of $750,000, and AUK Corporation bought the whole thing for $1,200,000. Imagine buying Jeff Bezos's Amazon Corporation for $1.2 million. Anyway, Amazon Corporation has assets with fair market value of $1.4 million. Basis is $800,000. It has no liabilities, no loss or tax credit carryovers. AUK Corporation files a timely Section 338 election. Assume that both the aggregate deemed sale price and the adjusted gross up basis is $1,306,329. As soon as I saw that, my first question was, where in the world did they get that number? We'll see where they got that number in just a minute. What are the tax consequences of the 338 election to Amazon Corporation and to AUK Corporation? Okay, so the value of Amazon's equity, what AUK paid for it, is $1,200,000. The deemed sale price, they told us, is $1,306,329. The basis of Amazon's assets, when you add all the assets together, compute their basis, it came out to an even $800,000. So Amazon is going to have a realized gain of $506,329. The tax on $506,329 at 21% is $106,329. Aha. That gives us a clue as to where they got that deemed sale price. Deemed sales price is the amount we paid to the old stockholders of Amazon, Jeff Bezos and his friends, $1,200,000, and the amount we paid to the IRS, $106,329. That's where they got $1,306,329. So if you're looking at that, you say, why did they choose that weird number? Now you know, that's why. Okay, so basis of Amazon's assets is stepped up to the $1,306,329. They didn't tell us anything about the details of those assets, so we don't know how much was cash, how much was land, how much was inventory, how much was securities. But in total, $1,306,329. Amazon's E&P is now zero. Actually asked for the consequences to AUK Corporation, but there are no consequences to AUK Corporation other than they have this subsidiary that they paid $1,200,000 for. AUK Corporation itself, the parent company, does not have any direct tax effect that they need to report on their return. Letter B. Assume that Amazon Corporation is liquidated immediately following the 338 election. Now, what are the tax consequences of the liquidation to Amazon and to AUK? Okay. Liquidation is a non-taxable event AUK's basis in the Amazon's assets will become Amazon's new basis. So Amazon got the step up in basis, then they did the liquidation, and AUK takes over those assets at the new stepped up basis. However, that 1,306,000, etc., was distributed to the assets. AUK's basis in the Amazon stock is gone. That 1,000,002, that just disappears. That seems a little unfair, but you can't have both. You can't have the stepped up basis in the assets and also your investment in the stock and have them both hanging around. So the basis in the stock goes away when you do that. And that finishes our final topic on chapter 6. We will start chapter 7 shortly.